As we near the end of 2021 and we look at outlooks for 2022, it's impossible to do it without referencing the threat of inflation. But there are still a lot of forecasts out there predicting growth in the US that hasn't peaked yet, will potentially do so in 2022, and some forecasts are seeing growth in that year at above 4.5%. Joining me today to talk about his views on the US economy in 2022 is Dan Nathan, principal at Risk Reversal Media and CNBC Fast Money contributor. Dan, welcome. It's great to see you again. Great to have you here with us. Let's talk about first growth and what we're expecting in 2022. Now, a lot of those inflationary pressures that we've seen have been the ones hindering growth in 2021 and the prospects of growth in the future. Now, we still have supply chain disruptions. We still have elevated commodity prices. But on the flip side, we also have a strong housing market, a strong jobs market. We have increased fiscal spending. So are we over the worst part of it? What are your views from the US going into 2022? Are we going to see a positive output gap next year?
Yeah, so it's really interesting. I mean, Daniela, you and I have talked about it over the course of 2021. I mean, this inflation story really started to creep up. When we started to hear the expression, in the early part of this year, I think people were not particularly worried because they were more optimistic that we would be, at this point of the year, towards the end of it, beyond the pandemic. And then some of those supply chain disruptions that have caused prices and wages and goods and services and some commodities to increase, we thought we'd be behind that right now. And I think the U.S. Federal Reserve, calling inflationary pressures transitory, I know that they caught a lot of crap about that, right? And the fact that Jay Powell just threw it out the window a couple of weeks ago and got a bit more hawkish, to me signifies that they've been absolutely turned around. They've gotten a bunch of stuff wrong. But at the end of the day, I think what they will be most wrong about is kind of throwing in the towel to the inflation argument, because I think back to pre-pandemic. This was a black swan event. No one saw this coming, okay? No one knew how long it was going to last or what the implications were going to be. And I don't believe, forget the health effects, which have been truly horrible and continue to be so, I don't believe that a virus is going to change the way the global economy works for here on out. And we were more worried about, or a lot of people were more worried about, disinflationary pressures, right, from technology and globalization. And now all of a sudden, because we've had this really weird year and a half, almost 2-year period of bottlenecks and disconnects, and everything, the global economy's changed for good. I don't buy it. So I think Fed Chair Powell basically rang the bell as it relates to inflation expectations going forward. So what does that mean for the economy? He basically thinks that we're going to have these pressures. They're going to have to get tighter with their monetary policy, and that might choke off growth a little bit. And there's a scary word that a lot of strategists and economists don't want to see as it relates to risk assets, and that would be stagflation, right? So a stagnant economy or a slowing growth economy coupled with more hawkish sort of Fed action. And then all of a sudden, what does that mean for risk assets? And I don't think it's great. And I think those are the sort of palpitations the market is dealing with right now. All that being said, the S&P 500 is less than 2% from its all-time highs right here, and it doesn't seem particularly bothered. But I know that you guys do a lot of great work all over the globe. There's other parts of the world that are really struggling, I think, with kind of figuring out what growth looks like relative to inflation and when they come out of the pandemic, if that makes some sense.
Yeah, I mean, you've opened a can of worms here, so I'm just going to go with it. You talk about the Federal Reserve, you talk about inflation and their views. I just want to get quickly your views on, did the Fed, and I've asked this question many times in the last few days because I'm really interested in seeing people's opinion, did the Fed overreact? And you could say this about all central banks, but let's focus on the Fed. Did they overreact? Did they act too quickly at the beginning of the pandemic, lowering rates and introducing a lot of monetary stimulus into the economy without knowing the full-on effect of what such an exogenous factor would do to an economy? I mean, real rates are very, very negative. We've got inflation growing and rates aren't. Did they act too soon?
Yeah, I don't think so. I mean, if you think of of their mandate, the Fed's dual mandate is stable pricing and full employment. And if you think what they did, they staved off a credit crisis when they hit the markets kind of early, taking Fed funds to zero, and then just basically starting quantitative easing, something that market participants at this point, or at that point in early 2020, we're pretty familiar with, right? If you think after the global financial crisis. So I think they did their job in that regard. And then the fiscal aspect of it with the payment protection and all that sort of stuff, it kept people, at least if they weren't employed, it kept money coming in, right? So we went from, yes, we had tens of millions of Americans in particular that lost their jobs, but we also had this transfer. So your question, whether it was right or not, no one knows. But what they did do is avoid the worst case scenarios as it relates to the economy, a prolonged recession, possibly a depression, that sort of thing. Now, the question that much smarter people than me, economists, and I am not one, I'm just a dumb old market participant here, will be debating for years and years and years whether this period of easy monetary policy has just ruined everything, right? It just ruins price discovery. It ruins this and that. And we might be dealing with the ramifications for many decades to come. But here's what I know. I've been in the markets for 25 years, and we've experienced now 3 in my lifetime major events: the dot-com bubble and burst, right? And then the global financial crisis in 2008-9, and now this. And each time the Fed iterates on their playbook, they know that they have to stay easy. And most importantly, if you look at interest rates over that 25-year period, it's upper left to the bottom right, okay? Interest rates are never going up meaningfully again, because you think about that period when Jay Powell was the new Fed chair back in 2018, and he started raising rates, and the 10-year got above 3%. The stock market went down 20% in a straight line because of growth fears and that sort of thing. So I think they're going to remain easily accommodative. As far as speeding up the taper, which they just announced this week, of the bond purchases, that was the mistake, in my opinion. To your point, it wasn't that they did it so early, is that they kept doing it for so long.
Right. So you were talking there about stocks and expectations. You were mentioning just before about the S&P being off those all-time highs. I know you and Guy talk about this a lot on, the macro market call about small cap stocks and essentially the Russell 2000, right? And we've spoken to this before. We saw a breakout at the beginning of November. We thought they were going higher. Since then, it's been a clear downtrend, and it's been constantly this question: do they want higher rates? Do they not want higher rates? And now that we potentially have a clear path of higher rates, what are they telling us? The fact that we're seeing it kind of in a downward channel, are they telling us that these more economically sensitive stocks are concerned about growth?
Well, that's a great question. I mean, Daniela, we talked about higher rates. We talked about the Fed getting more hawkish, this hawkish pivot. I don't see rates higher. I see the 10-year U.S. Treasury yield right now, as we're talking, at 1.39%. They were 1.77% at the highs of this year back in March. Now, the 2-year, yes, I see it 62 basis points, and that's up considerably over the last, let's say, 3 or so months. It's basically gained what the 10-year has lost. But when I think about this, I'm thinking about high inflation readings, and I'm thinking about where the Fed funds is, and I'm doing some simple math here, and I'm saying we're deeply negative, as you just said, right? So there's no shortage of the things that the Fed can probably try to do to make that less negative, but that's good for risk assets, right? Why are we seeing NFTs trading the way they are? Or why are we seeing any piece of fine art that's not bolted down trading? You mentioned the housing market. It's a little bananas right now. You know what I mean? This can't end well, because at some point, if the Fed just needs to normalize, which they're trying to do a little bit, we're going to see an adjustment in risk assets. We're seeing that in small cap stocks right now, right? That are very economically sensitive. You just mentioned the Russell 2000, and we're also seeing that in high valuation equities that are getting absolutely pummeled. And when you think about that relative to where the S&P 500 is, up 23 or 4% on the year, down less than 2 or 3% from their recent highs, you got to say to yourself, there's a massive disconnect going on right now. So the crowding that investors are doing in some of the largest perceived safe names, Apple, Microsoft, Alphabet, a handful of other tech stocks, that seems very dangerous as it relates to 2022 and what the setup is for stocks.
So you were talking there about, these safe stocks and potentially safe haven trades and where people are trying to put their money. But let's talk about gold, because essentially we've seen CPI and PPI reach decade highs in recent days, but gold hasn't been doing anything. So if you are assuming, and a lot of people do, that gold moves on inflation expectation, does this mean that inflation expectations going into 2022 aren't as high as potentially we may think they are?
You teed me up here, Daniela, because you and I've talked about this over the course of the last year or so a couple of times. I just don't think gold is that barometer anymore, and I think it really is about crypto. And I'm not telling you that I think Bitcoin is the best inflation hedge or indication of inflation expectations. I think the incremental dollar that wants to think about scarce inflation hedges that gold had been for hundreds, if not thousands of years. I think they're thinking about Bitcoin or maybe some other cryptos in that capacity. So one of the reasons why we've seen, again, gold from all-time highs in the throes of the pandemic in 2020 in the summer. Do you remember it was trading, I don't know, close to 2,000 an ounce? And what have we seen? Upper left, bottom right, a really well-defined downtrend. It really feels like it's going to break. Now, crypto, Bitcoin in particular, has gone the exact opposite way, but it's also pulled back about 30%, just as, to your point, inflation expectations are reaching their highest, as we see that CPI print the highest in 40 years or something like that. So at the end of the day, I think that might it be saying that we just top ticked inflation, expectations going forward? I just gave you that rant about 10 minutes ago. I think so. And I just don't think gold is the place to be anymore. I think the next investor, the investor that you're speaking to, who are listening to this or watching this on their mobile phone, and the way that they're going to be investing going forward, I don't think gold is going to be that interesting. But I do think it's a great trading vehicle, right? And it really, because there is, $12 trillion of interest in it, and the central banks around the world are interested in it. And there's a lot of investors who are looking for different ways to express views as it relates to inflation. So I'm just like, I think it's a great trading vehicle. I don't think it does what people think it does or says about inflation expectations.
Yeah, and we were talking there about the dollar and inflation expectations and potentially the way bond yields are going to react as well. So with your views about these expectations and potentially the Fed not offering as many rate hikes as people are pricing in, and how yields are going to move in that favor, how do you think the dollar is going to perform more on like a macro level? I mean, how will it perform against these other currencies that have struggled with inflation for longer, like the euro, the Japanese yen, the Swiss franc even?
Yeah, I mean, we've seen this nice move in the dollar, the Dixie, and we know that half of that basket is basically the euro. And one of the reasons that, I just remember when we came out of QE and we came off zero interest rate policy, and back in 2014, 2015, what did we see happen? We did see rates go higher, and we did see the dollar rally here. What's going on with the dollar right now, though, relative to some of these other regions or some of these other currencies, it looks like a safe haven, which is not always, I mean, that's predominantly been the case overall, but coming out of the financial crisis, that shouldn't have kind of been the case. You know what I mean? So, I think about the Dixie at this level. It's at 96 or so. It feels like it wants to get back to 100. A lot of that has to do with, I think, sentiment towards the euro and some other currencies that it trades against. So to me, I think the probably dollar strength makes sense. What are we seeing in treasuries right now? We're seeing a bid, right? What are we seeing in the dollar? We're seeing a bid. We're seeing U.S. equities act very well relative to many other places. So U.S. in general feels like a bit of a safe haven here, but mind 2022. This is going to be a midterm election year. You remember how elections in America over the last, 10 years or so, there's been a lot of excitement. So we could go from the shiniest house on the block to maybe not so shiny, if you will, in the very near term.
I just want to finish off quickly with earnings, because earnings have been focused in 2021. We've been really, really strong earnings. But the way PPI and CPI are moving, we're seeing this gap between the producer and the consumer. What are we going to see in 2022? Is this trend going to continue? Are they going to start to be hindered by those higher input costs? What are your expectations for earnings?
Yeah, listen, I think that input cost is going to be less of a concern, in my opinion. When you think about earnings and growth rates this year in 2021, they were against some really easy comparisons in 2020, as you know, right? And so we think about just all the disconnects that happened with economies being shut, a lot of businesses, having to deal with a lot of extra costs. Well, now we've had this really easy monetary policy. A lot of companies have been buying back a ton of their stock, right? And so you think about that, that's really helped earnings. I would point to a couple high growth, high valuation, high quality, and this is important, high quality companies here in America that have been really important themes in the SaaS space, software as a service. Salesforce.com, ticker CRM, and Adobe, ticker ADBE. Both of these stocks they had disappointing guidance. They reported in the last couple of weeks, both of the stocks the day after the guidance were down 10%. These are $260 billion, $70 billion market cap companies that lost 10% a day because investors were unhappy with the guidance. Okay, so now these stocks are down 17, 18% on the year from their recent all-time highs just made last month. I think that's really important. Keep an eye on this. As the calendar turns, we're going to get into January. Q4 earnings season is going to start, and we're going to get a whole heck of a lot of data on what companies see as visibility. And to your question about input costs, don't be surprised if they say, we're still surprised at how long this is taking to come out of this and input, because they have nothing to lose by doing that, right? They kind of can set expectations a bit lower by doing that. So we may see a bunch of that when earnings start rolling in mid to late January.
Well, Dan, thank you so much. It was great to see you again. Great for all your wonderful insights. And that was Dan Nathan, principal at Risk Reversal and CNBC's Fast Money contributor, giving us his views on what to expect from the US economy in 2022.
For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.